I'm going to give you my 5-step process that I use with clients that start with as little as $500,000 with us to get them up to $5 million over their investment horizon. Step number 1, account setup. The truth is that there's not a lot of great places to invest that are open architecture. Open architecture are where you can buy anything that you want, where there aren't going to be prohibitive fees or high commissions that are going to really prevent you from being able to give you the return that you need. And a lot of places today are essentially just brokerages. They're there to sell you stuff that they offer, right? So they'll sell you mutual funds, they'll sell you annuities, they'll sell you life insurance. You can ask this when you're interviewing the financial advisor that you might want to work with. Hey, what access do you have to different investments? Are you open architecture or is it a closed system? Two of my favorite places right now to invest money are Robinhood for people that are do-it-yourselfers and are looking to open an account, be able to buy anything that they want. The second place where you can invest is Charles Schwab, which is where we house the majority of our client money. They're a great brokerage. They allow us to buy pretty much anything that we want. You can buy most stocks, ETFs, and mutual funds at no cost, which means that there's no commission or trading fees. Step number 2, build a cash reserve. So do not invest 100% of your money. You need to keep some money set aside so that you're not really having to pull money out of this investment account for a long time. Investments in many cases can take 2, 3, 4, 5 years for that thesis to play out and for you to experience a full market cycle. So having 3 to 6 months of cash set aside makes total sense. Step number 3, build a diversified portfolio of stock index funds. Now, what are stock index funds? If you remember from video 1, my son was talking a little bit about, hey, I want to invest my money into 1 or 2 different companies. And I gave you the probability of success there. There's a 95% probability he's going to buy a stock that's either going to be a complete loser or a zombie stock. There's only about a 5% chance that he's going to buy a super stock, which are those stocks that end up creating all of the return for the market. A great way to ensure that you're buying super stocks into your portfolio is to buy an index fund that has large numbers of stocks in it. So for example, one of my favorite index funds is actually the NASDAQ 100. The NASDAQ 100 is diversified. It has 100 of the largest stocks on the NASDAQ stock exchange. Another really great index fund is the NASDAQ Composite. You can see it on TV. It has 3,000 stocks, so it's hyper diversified, and you can buy all of those with 1 share. So every time you invest, you're basically buying 3,000 of the most innovative, exciting companies in the world, and you're buying them in the US stock market. Beyond just the US stock market, I actually think it's super important to diversify in other markets. We're not the only innovative place in the world that someone could invest. And certainly there's places like China, Europe, Australia, Japan, India. All these places have companies that are world-class. And actually, getting exposure to those companies makes a lot of sense. One of my favorite index funds to invest globally is the MSCI EFA, or Europe Asia Far East Index. That one will give you exposure to all kinds of companies all over the world. The important thing when you're investing internationally, though, is to know that even though you might want exposure to those companies, you don't necessarily want exposure to their currencies. Meaning, I think it's important to stay rooted in the dollar because ultimately you're going to convert that money back to US dollars, and you don't want to lose money because a currency has depreciated against the dollar. There are several US dollar currency hedged index funds that you can buy that will give you broad-based exposure to other country stocks. And I think that the combination of the US and international stocks should be the vast majority of your portfolio. If you're wondering about allocation, that kind of depends on your age and your time frame. But essentially, I would say about 75% of the money should be domestic and about 25% should be international. And that is the core of your portfolio. This is where you can actually start to layer on some individual stocks. So for example, I'm going to show you a portfolio in just a second here that's a diversified stock portfolio. It has stocks in the US, it has stocks international, it has large, mid, and small size companies. And you're going to see how that portfolio has performed over the last 10 and 20 years on the screen here. Notice, if I add just a 10% sleeve, meaning I take 10% of the money in addition to that core, and I say, okay, in this 10%, I'm going to try my hand at stock picking. And I'm going to pick some of those companies that I'm either really excited about, passionate about, or I just want to support them. I think personally, if you're looking at companies, you should be looking for companies that are in attractive industries. They're creating compelling value for their customers. They have some kind of sustainable competitive advantage, and their people are interested in building the business, not just babysitting it. And there's tons of babysitters out there. As long as those stocks have those 4 qualitative quantitative criterias, and they're financially sound, meaning they make money, they're not losing money, they're not overly burdened by debt, I think it's totally healthy for you to be buying between 1 and 10 stocks and adding them to your portfolio. I've got a couple of rules when you're adding individual stocks to your portfolio. The first rule is I never allow more than 10% to be in individual stocks. I think it's important that 90% of your portfolio be core through index funds, and then 10% be satellite with some of these individual stocks that you can have orbiting around the core of the portfolio. The second rule that I have is I don't allow any one company to be more than 10% of the total. Again, if we have 10% for stocks and we buy 10 stocks, each of those stocks is going to be roughly 1%. But if any of those stocks end up being super stocks, they could very easily get to 10% of the portfolio. Anytime they do, I pare them back. I don't necessarily sell all of them. Here's an example of a portfolio that has 10% in individual stocks and 90% in index funds and how it's performed. Let's talk about what happens if you're wrong and what happens if you're right. If you are wrong and you pick a losing stock, maybe you're just terrible at stock picking and you've picked all companies that have gone bankrupt. What's happened? 90% of your portfolio still grew and you did quite well over time. Now, what if in that 10 stocks that you bought, you did happen to strike on a super stock? Let's say you thought about Amazon before Amazon was Amazon, or you really loved Netflix and you bought it right around the time that they put Blockbuster out of business. I'm going to show you an example here of what happens when you add a super stock to the portfolio and how it can enhance your return. Look at the graphs there. The first graph that you see is just a portfolio full of basically stocks that are index funds. The other portfolio is the one that you had where you had a super stock in there, meaning you had a winner. And the bottom portfolio is what would have happened had you basically picked all losers and all of them went bankrupt. And you could see in all cases, you would have made money over time. And that is the point of all of this, right? We want to put the odds in your favor as an investor. So here at Verde, we do pick individual stocks for clients, but the way we mitigate the risks is by having 90% of the portfolio invested in index funds, ETFs, mutual funds that give them broad-based exposure to the markets. And then 10% will pick in individual stocks. And if we're right about those 10%, boy, it can enhance the return. If we're wrong, it's not going to hurt the client that much. Step number 5, it's also important when you buy as it is what you buy. A lot of people just think about, well, I'm going to invest in the market and I'm just going to kind of do it once and then I'm going to just like leave it alone. That's really not the best way to invest. I have 2 strategies for how I enter into the markets and also how I exit the markets over time. I tend to like buying through a dollar cost averaging strategy. What that means is that when I'm buying a stock, let's say I really like a stock in my portfolio and I'm going to buy some index funds as well. Rather than putting all of my money in at once, I'm worried about possibly putting my money in and then having the market tank and having buyer's remorse, right? So if I buy in once a month, very similar to what many of you might be doing with your 401k plan, that actually works really beautifully because you're buying in on those dips as well as those ups, and numbers tend to average themselves out. So you're not getting the worst price or the best price. Another strategy that I tend to employ, and I really like this one, if you seem to have a very opportunistic kind of mindset, I think this strategy can actually work even better than the dollar cost averaging strategy. What this is buying in on the dips. You're not going to be able to predict when those dips are coming. But anytime the stock market dropped from its peak to a trough by more than 10%, to me, that's like a sign that I need to pay attention, because anytime it's 10% off or more, I think of it like the best sale in the world. I'm going to be buying these great companies at a 10% discount. If it drops by 20% or more, I'm buying again. And then last, if it drops by 30% or more, that's when I deploy the last little bit of cash I have. And from that point on, I do not buy anymore because I'm out of money. The reason why I do that is I want to be ultra opportunistic. In many cases, because I'm young, I'm 42 years old, I'm not going to be touching my money for a long time, as are most of you that are watching this video. You can afford to leave your money alone for a little while and to buy in on those dips. Now, why do I stop buying at 30% down? Well, in many cases, the stock market's only going to go down 30% in the most crazy scenarios. Like think of COVID, think of after 9/11 or the great financial crisis. The last 20 years, we've had 3 of those incidents. So you don't get a lot of those, but you will typically get a 10% peak to trough drop and even a 20% peak to trough drop. Those are called corrections and stock market recessions. So buying in when other people are really fearful is a great strategy for making some extra money. In the next video, we're going to be talking about the lies that financial advisors tell you, how you can spot them, and how you can make sure that you're successful in working with an advisor.